Well, the impact of fees on investment returns are well researched and documented. So do we take heed of what research says, or do we ignore this? Now, the passive industry led by the ETFs certainly makes a case for lower fees, but at the same time have active managers changed the way they charge fees. So welcome to all of you. And Colin, I'll start off with you. Let's just talk about the components that go into fees that you pay active managers, because you've got the total expense ratio, which is of course seen as the benchmark. It was introduced in 2008, but break down the fee components for us.
Yeah, there's various components to a total expense ratio. So it's kind of an overall kind of cost ratio to a fund. Generally, the two main components of a TER are investment management and the investment administration, which are key parts of running a unit trust portfolio. There's additional costs such as custodian fees and trustee fees. And there's another component to it which is often forgotten by investors, but it can be quite important, and that's a performance-based fee. If there's a performance-based fee arrangement in place, and for example, if the fund and fund manager have outperformed that hurdle, that performance-based fee also gets added.
How common are performance-based fees in South Africa?
They seem to be a lot more common than they used to be. They were quite rare a number of years ago, but it seems to be quite pervasive in the industry now. All kinds of funds and fund managers actually charging performance-based fees. Whereas I think ideally you really just want the cream of the crop, or your top echelon of active managers charging performance-based fees. So I think it's something that has got kind of out of control in recent years, and I think at some point the authorities do need to clamp down on the excessive use of performance-based fees.
Oh dear, another thing for authorities to clamp down on here in South Africa. I mean, your view, Roland, in terms of fees and the TR, is it the right, should you be just focusing in on that?
I think we're catching up with the rest of the world. I mean, the TERs were compulsory overseas for a long time, and South Africa in 2008 moved in that direction as well. So it's very welcome that there is some kind of summary number, but there are a number of fees that are not included in the TER that investors should be aware of and aren't always told about. But maybe Colin can highlight some of those. But the advice fees and the amount you churn in the fund, I don't know how big those are as a component, but what else is there in the non-disclosed part of the TER?
I suppose one could talk about market impact, in fact, but it's a number that's very, very difficult to get to grips with.
But if a fund manager churns, the costs in terms of the JSE fees and the brokerage fees are not part of the TER, right? And any advice fee that I get before I invest in the fund is not part of the TER number either. So these numbers could, double the TER that we see on the fact sheet.
Well, as a matter of fact, what I actually want to do is I actually want to show you the impact that fees actually have on investments over the long term, because I think this is one of the issues that we kind of brush underneath the carpet, and we kind of say, look at returns, these things are very important, but we kind of forget about actually talking about fees. So what I want you to do is I want you to look at this graph that I'm about to put up, and I'd like you to look at the impact that fees actually have on your long-term returns. And what you're seeing over here is you're looking at an investment period of 30 years. Now, we've chosen 30 years here because you should be investing long-term if you're going to be in equities. We're assuming here that you're going to get yourself a 12% rate of return. And let's assume you pay no fees, which is now obviously not doable, but let's assume you could get away with it. Well, guess what? You keep absolutely all your money. You keep 100% of your total gain. And for every 100 Rand that you invested 30 years later, that would be 3,559 Rand that you would have ended up with 30 years later. Let's assume now that you pay a 5% fee. And therefore, you're quite frankly only compounding out at about 7% per annum. What is the total? What do fees do to your total return? Well, there you can see the line right at the bottom at 5%. You basically keep 23% of your total gain that you could have had if you just kept 100%. And I mean, that's about 807 Rand. That's basically the total gain that you get. So is it positive? Yes, it's not negative. Is it bad? Well, relative to paying no fees, yeah, it's actually quite bad. Because quite frankly, the compounding factor is the factor that you're getting on all the growth, and that's just compounding out. It's again,
so are you saying that 80% of your net wealth goes up in smoke with a 5% drag per annum over 30 years?
Yes, and obviously incrementally that gets less and less and less over, as you're paying less and less fees. and that becomes really important.
So what we're trying to point out also with this graph is because of compounding, the difference, 1% difference or 2% difference in fees over the long period has a big difference, makes a big impact. And that, of course, goes for compounding returns as well.
I mean, if you do this, if you invest over shorter periods of time, and obviously you're getting a positive gain, do fees make a difference? Yes, but you're not getting the real effect that start making its impact when you're starting to compound over longer periods of time. And that's what investors really should be doing, is compounding out over longer periods of time. And that's where fees really make the difference.
Mm-hmm. Let's look at the South African landscape now and look at the fees we charge across various asset classes generally and how that's changed over time. And of course, Kwebi, you've got a graph there.
Yeah, I mean, have a look quickly at the graph that's on your screen right now. That'll show you, as a South African investor, what are you on average paying over here for various fund classes. So when you look right at the top end of the screen over here, you'll see international equity, and that was back in 2008. You could have paid a fee on average of about 2.24%, and that fee today is about 2.06%. What about general equity? Well, the fee that you're paying at the moment is about 1.92%. Bond funds are about 0.78%, and then money market funds at about 0.47%. And I mean, Colin, what is the trend over here? Are we seeing TERs kind of starting to shift slightly down in South Africa rather than staying stagnant or potentially increasing?
Look, over the period in question here, we've seen a slight downward trend in TERs over this 4-year period. For the 4 categories in question, the one category where there hasn't been a downward trend has basically been the balanced fund category, where fees have basically stayed at very much the level that it was at 4 years ago. So a general downward trend, but again, nothing meaningful. I think if you had to look at the difference between the TERs, and these are kind of your simple average of the funds in the respective categories, there's a slight downward movement, but nothing significant.
Are there any areas within, of course, these broader asset classes where fees are particularly high in South Africa, where there's a lot of controversy around the high fees that have been charged?
Certainly the balance fund category, the fees are quite high when we compare them to other countries, even though it is a difficult comparison, and doing fee comparisons across countries is absolute minefield. Just actually trying to do the research just for the show just showed you that there's the potential.
Give us an idea of why. I mean, give us an example between 2 countries and the differences when we talk about fees and looking at that across from a global perspective.
A good example is Canada, in fact. In Canada, they are obliged to include the advisor fee into the TER. So that's obviously going to push the fees up for Canadian funds, and now comparing that to South Africa, where we don't include the advisor fee in the TERs, it's going to push those down, and it's going to imply, a big difference between fees, i.e. Canadian funds are a lot more expensive. But when you equalize the basis, now it's hard to do a comparison, because how do you equalize the basis of the comparison? So I think one's just got to look at some of the detail here and realize that the figures that we show here are not perfect, but it's the best we can do with the information available at this stage.
Yeah.
As a matter of fact, let's quickly show you what those Canadian numbers actually look like, just to show you visually what Canadians actually pay on average for general equity. So this now assumes you are a Canadian investor and you're trying to just invest in the equity markets. You'd be paying on average a total expense ratio of 1.91% there. That obviously includes some advisor fees. Australia, 1.77, and there you can see South Africa at 1.55. I mean, Colin, 1.5%. I mean, it kind of seems reasonable to me. We kind of just below kind of what the Australians are charging, certainly, below the Canadians, even though that's not a fair comparison. But it doesn't seem wrong to me. I mean, the American market is probably the longest running market as far as mutual funds are concerned. And I mean, those are sitting at about 140, 145. So 155 doesn't seem like a bad number to me.
It seems reasonable. I think it's not out of line with world standards. I think it is competitive. I mean, despite some of the discrepancies that I've mentioned, and yeah. So I think on actively managed general equity, not out of line. But obviously within this figure that we're looking at, you've got the two sets of funds. You've got the set of actively managed funds, and then you've got a set of passively managed funds where the average TR would be significantly lower.
Exactly. And that, of course, brings us to the next point, is what is the ETF world done to the active management fees that are being charged. And, of course, there you have a comparison, and you can see the difference. I mean, the sharp difference there. And if you're a long-term investor, and Roland, you, of course, would be able to add to this in terms of the type of returns we've seen from ETFs relative to active investors. If you're an investor looking to make money over the long term, we know that fees really eat into earnings if there's even that small difference. So why go for an active manager?
Well, I mean, the anticipation with active management is that they outperform the fees they charge. At least that's the anticipation. So if they don't do that, and on average, just keep in mind, you can't all outperform. In fact, on average, after fees, you have to, on net basis, underperform because it's a closed system, right? So if some people outperform, some people underperform. Without fees, you're going nowhere, but with fees, you're actually losing money, right, on average. So the argument is that you've got to pick the right fund managers and not the average fund manager. But I think what is important to realize in South Africa is that the proportion of the TER that is going to the performance-based fee has certainly increased over the last few years. I remember 5, 6, 7 years ago, we had funds called balanced funds, which were just asset allocation funds that charged a simple base fee with no performance-based fee. And those exact same funds suddenly revamped themselves and remarketed themselves as absolute return funds with CPI kind of mandates. And suddenly, they're still balanced funds. They're still doing pretty much the same kind of thing they always did, but now they charge a performance-based fee to beat CPI plus 3% or something. Mm-hmm. And that has increase the cost in terms of the proportion that is coming from performance, because equities and bonds beat CPI as a tracker fund already. So it's not that difficult to outperform. And if you're charging a performance-based fee, the costs become a lot more prohibitive compared to a less costly passive kind of strategy. Yeah. But we don't really have any balanced funds in the passive space in South Africa yet.
Let's just look quickly at what fees you pay for active management in South Africa relative to passive management. And there you can see, and Roland touched on this just now, general equity, you could see the blue category right at the top of the screen. What do you on average pay for general equity active funds? Well, you can see about 1.7%. And that's relative, obviously, to passive funds, where you're charging about 0.70%. Interesting comment for me that passive funds have gone from 0.56% all the way up to 0.70% that you're seeing right now. I mean, which shows kind of, and it's certainly not a performance fee, but certainly a performance management fee creep that you see over time. Is there a reason for that kind of behavior at this stage?
Yes, what's happened here is we're actually dealing with a very small number of funds. So as soon as a new passive fund comes along, and if it's got a slightly higher cost, it bumps up the average for the passive funds quite a bit. So that's what's happened in this instance. But still, as we can see, passive funds on average are about 1% cheaper. And a lot of that's again got to do with the ETFs, as you mentioned, coming into the industry. But one thing that has surprised me is that with low-cost ETFs, it hasn't really sparked the debate, and it hasn't really got investors as sensitive or as concerned about costs as you would have expected.
Is it just the South African investor that we just accept that if you're going for the active route, those are the fees that are being charged?
Well, actually, the worldwide trend is investors are voting with their feet now. There's a major trend around the world of investors moving out of high-cost, actively managed funds into low-cost passive funds. So
it will happen here. Is that what you're saying?
I think it will. I mean, I'm surprised that it hasn't happened more, but I think the trends around the world are showing that investors will eventually kind of vote with their feet. And what will be good about this process is if investors move a large percentage of funds into passive fees, it'll get the active managers thinking about their level of fees, and hopefully what it will do is it will pull fees down, and certainly funds with excessively high fees hopefully will be washed out of the system, and we can get active management at the correct level of pricing. I think active management is generally a bit too high on average, and I think it does need to come down a touch.
That 1% difference in fees is actually an interesting number, because if you look at the chart that you put up earlier on, Kirby, 1% over 30 years is 30% of your wealth that you could have more if you saved yourself 1% per annum. So it is a significant number in the long run.
Yeah, exactly. And that's the purpose really of the show, is really to understand how fees eat into your earnings over time. From an international front, Kobie?
I mean, sorry, let me just make a point quickly about exactly what Roland said over here. The old adage again applies here: buyer beware. Understand what you're buying, understand what kind of performances you could create and potentially could be available to you as a long-term investor. Understand how that helps you achieve certain objectives, and that might be personal objectives, it might be more holistic objectives, but understand all of those, and then you'll either find yourself being an active or a passive investor. And neither of them are wrong. But if you're going to be active, find yourself the most cost-effective way in order to do so. Nobody goes out and says, look, I'd like to buy a car, and quite frankly, I'm happy to pay whatever price, even if I get overcharged for it. Go find somebody that could potentially charge you a fairly decent price, for what you need to get.
Yeah.
The other thing, obviously, and Sam, taking on from what you said just now, let's quickly look at balanced funds. And what we're looking here is we're looking at the Prudential Manager averages or equity averages, and these are managers obviously with a balanced mandate: equities, bonds, property, cash. If you're a South African investor, Colin mentioned this already, 2.13%. That seems kind of hefty. Canada 2.01, Australia 1.61, and you can see the United States and the United Kingdom. Colin, why balanced funds? Why so expensive? I mean, there's obviously a ton of money chasing this because it has to be Regulation 28 compliant. Why so expensive in South Africa?
Yeah, it's a good question, and I think what's happened here is there have been certain things specific to this particular unit trust category. Is that traditionally a lot of your big names in the investment industry had their balanced fund in this particular category. But a lot of your traditional balanced funds have actually moved out of this Prudential medium equity category into another category called Prudential variable equity. And there's been a wholesale move. So what's actually happened is this category has actually been left with a lot of kind of high cost fund of funds and some other funds there that have caused this particular average to be quite high and higher than you would have expected. And as I say, some of the lower cost single manager funds have moved across into another category.
Yeah.
So we've just got to bear that in mind. Just some technical factors.
Well, we've run out of
affecting this
time
figure.
for this discussion, unfortunately, on fees. But Kobie, one last graph from you on the international investing front.
All right, okay, well, let's choose international equity. This now assumes that you are an international investor, obviously, and you're trying to invest internationally. What are the fees that you're going to be paying? And as a matter of fact, I think I might have showed you this graph already. So let's move straight on to bonds. And this was, if you're a bond investor, you want to invest in fixed income. If you're in Australia, well, expect to pay about 1.38%. In Canada, 1.27%. The United States, 1.02%. And this is where South Africa actually fares quite well, 85 basis points.
Well, there we go. Those are some of the numbers to get your head around. But thank you so much.